meeting at the top of the hour. Janus Capital's Bill Gross has a message for Janet Yellen and the Fed, if they're listening. He writes in his latest outlook, if only Fed governors and presidents understood a little bit more about monopoly and a tad less about outdated historical models such as the Taylor rule and the Phillips curve, then our economy and its future prospects might be a little bit better off. That's a direct quote. Actually, I think he doesn't mind if they're listening or not. He's happy to say that. Joining us now to discuss the Fed is someone we always listen to, Bloomberg Intelligence's chief U.S. economist, Carl Riccadonna. Carl, thanks for coming on the program.
Sure thing.
Hey, Sherry and I were talking about this morning, and I was thinking, Bill Gross has a lot to say for what the Fed shouldn't be doing or what they're doing wrong, but is he really telling them what they should be doing? I mean, does he really want helicopter money and another $1 trillion on the balance sheet?
Well, he's definitely offering some advice, but to say that the Fed is making a mistake, I think, is a bit of a stretch at this point. We have a sluggish economy and a Fed that's moving very, very gradually to normalize interest rates. So I think that the course to this point seems to be relatively on the mark.
Taylor and Phillips models for guiding interest rates, that would be based on inflation, also unemployment rate, false idols. What's your take on that?
Right. I think that Janet Yellen and company don't subscribe too closely to the Taylor rule in the first place. It provides a rough policy framework, but the element of human discretion is much more powerful than just using a simple black box model like the Taylor rule. So I don't think they're hewing too much to that. What's, I think, more relevant here, and this is exciting in macroeconomic terms because we'll be able to put the theory to test in the second half of the year, I believe, is this commentary on the Phillips curve. And I don't think we can say that the Phillips curve is broken until we have convincingly moved through full employment. And arguably, we've only recently done that if that decline in the unemployment rate we saw in May holds up. Full employment could be 4.5%, 4.75%, and so we don't know if that will create inflation pressures in the economy until we blow through those levels. Now, if we continue on a downward trajectory for the unemployment rate,
how much lower could we possibly go? I mean,
we could easily go back to 4%. Mind you, at the end of the 1990s, we had a 3 handle on the unemployment rate. So, it definitely is low. The Phillips curve has changed its slope. The shape has changed, and it's a flatter Phillips curve now. But until we've blown through full employment, we don't know that the Phillips curve is broken. I suspect it's not, and you're seeing increasing evidence of the types of clues that we're very close to full employment when we see increasing evidence of wage pressures across an array of industry sectors. So a little labor inflation could go a long way to boosting inflation, one of the Fed's goals, as well as providing a significant tailwind to consumer spending, which would really change the feel of the economy in the second half of this year.
No, exactly. So the Fed's meeting happened before the Brexit vote. So, and then they became more dovish even. So what does this tell us about the future of the economy?
This is what's going to be very interesting in the minutes here. So at the time of the June FOMC meeting, the Fed clearly took a dovish turn, and that was at the point where most folks thought that the Brexit vote was going to fail. And so now we have a reassessment of the domestic economy from the Fed, and on top of what we'll read in the minutes in just a few minutes, we'll see that actually things are even worse in light of the constriction and uncertainty caused by the Brexit vote.
But what you're saying basically is these are short-term problems to deal with. Obviously, the UK leaving the EU isn't going to have massive fallout on the U.S. economy, right? I mean, that's what we're hearing from it.
It shouldn't. However, we have to watch financial contagion, just like the sovereign debt crisis.
If that's not contained.
We have to see, what you see happening in the Italian banking sector and credit spreads, especially in continental Europe. If that continues to worsen, if bank lending conditions, interbank lending conditions continue to worsen, all of this has a risk of crossing the Atlantic.
Carl, fascinating. And of course, we'll have those minutes out in just minutes. Thank you so much, Carl Riccadonna, here joining us from Bloomberg Intelligence. A reminder that those FOMC minutes will be coming out in a few moments. And at 3 p.m. New York time, Bill Gross will be joining Bloomberg. We will get details on his monopoly note this morning. This is Bloomberg.
Breaking news on Bloomberg markets. We're moments away from the release of the minutes from the June FOMC meeting where the Federal Reserve held rates steady. I'm Vonnie Quinn.
And I'm Julie Hyman. Looking at the markets going into these minutes, we have seen a turnaround midday in U.S. stocks. They are now all trading higher. And in terms of bond yields, earlier the 10-year note touching a record low 1.32% before bouncing. Now it's at 1.39%. Let's go to Michael McKee in Washington for those minutes.
Go. Well, if you're looking for guidance for future Fed moves, you're not going to find it in these minutes. Instead, you're seeing a committee that is groping to figure out what the prospects were for the U.S. economy. Keep in mind the timing. This was after the dismal jobs report in May, but ahead of the Brexit vote. Brexit gets surprisingly little mention in the minutes, an acknowledgement the vote could be a risk and a pledge to monitor developments, but no detail on what members thought the risks might be or what policy response might be appropriate. However, most of the discussion was devoted to figuring out what the May jobs report meant. Remember, just 38,000 jobs were created. Many participants, the minutes note, felt the number was likely distorted by the Verizon strike and statistical noise. The labor market might be slowing, but in general, the labor market was stronger than the data showed. Some suggested the lower rate of gains could be suggesting a general slowdown ahead, while others, a few, blamed the weak hiring on the inability of employers to find employees. The bottom line, almost all the participants judged the surprisingly weak May employment report increased their uncertainty about the outlook for the labor market. There was also uncertainty about the prospects for inflation. Most felt it was on track to reach the Fed's 2% target. However, some thought the progress could still be very slow. Other concerns, the slow pace of business investment and the prospect of slower growth overseas affecting the U.S. economy. So what to do? Wait. Quote, participants agreed it was advisable to avoid overreacting to one or two labor market reports. Most judged that they would need to accumulate additional information. The minutes note, and remember the timing, that members, most of them, held to their previously announced triggers for raising rates. A pickup in growth, progress towards full employment, and an inflation rate on track to the 2% guidance. So while it's a terrible cliche to end a story by saying the outcome remains to be seen, that pretty much sums up the Fed minutes for the June meeting. A couple of quick notes, Vonnie and Julie. There was no discussion in the minutes of Jim Bullard's new economic framework, but there was a self-critique with several participants expressing concern the committee's communications efforts had failed to fully inform the public.
It's interesting, Michael, and thanks for that summary, because we were looking for a dovish set of minutes. It sounded like there was a massive change, and typically we're not all that interested in minutes. Market participants were interested in these. What dovish signals? It sounds like you didn't see that many.
You don't see very many dovish or hawkish signals. What you see is a lot of confusion and a lot of inability to agree on what might actually be going on, particularly in the labor market. That seemed to be their big concern at the time. Again, not much expressed in terms of detailed concern about Brexit, but some questions about what was going to happen to the labor market going forward and whether or not we were finally starting to see signs of inflation.
Mike, I'm curious, is there any mention of the now much hated dots that represent the Fed's forecast for interest rates? There's been a lot of debate about the utility of them, even some of the Fed members raising questions about them. Was there any talk in the minutes that this is something that was discussed?
No, maybe it fell under the rubric of that question about Fed communications and whether or not they were effective, but there's no detail on what they meant by that. And again, no discussion of Jim Bullard and his new economic framework. He was, of course, the member who left his dots in place and provided no long-term guidance, but no clarity on that either, Julie.
Really briefly, Michael, does it put July or September back on the table at all?
It doesn't take it off the table. I mean, July probably not, because they are looking for more information. We do get more labor market information on Friday, but they said they would want one or two more reports to give them some idea of what was going on. So September could still be on the table. These minutes don't move that needle one way or the other.
No change in WIRP so far anyway. Michael McKee in Washington, stick with us.
And let's look at how the markets are handling these Fed minutes. Sherry Ann is at the markets desk. So Sherry, as Mike portrayed it, these minutes are sort of going back to data dependence. Are we seeing a market reaction?
Exactly. So investors have a lot to digest today, not only the Fed's minutes, but also in the morning we just had those service providers expanding more than expected in June, showing signs of a healthier economy here in the U.S. But take a look at what markets are doing, because they were in the red earlier in the session, but now they've turned positively in the green. They've gained momentum around noon and they're now climbing. We're seeing the S&P up 0.3%, the Dow almost as much, and the Nasdaq surging 0.5%. Take a look at the S&P 500, because despite all of the losses, the previous session is now back in the green. It's gaining 0.3%, and we're still seeing it trade at around 16 times earnings, so one of the highest valuations around the world, above its own 3-year average. Of course, the S&P has been whipsawed in the past month, coming close about 1% to that record high. Take a look at gold, because we have seen investors, of course, flock to safe havens, and we're now seeing gold climbing 0.8%, still at the highest level since March 2014. What the BB-Dixie, the dollar, is doing, well, it was sort of unchanged before we had those Fed minutes. It's currently losing around 0.2%. Traders have priced out a U.S. rate increase until at least 2018, and we're now seeing bond yields not only in the U.S. but across Asia, across Europe, falling to record lows. We're seeing about $10 trillion of government debt across the world trading below zero, yielding below zero. You're seeing the 10-year yield currently rising 0.9%. We saw another record low today of around 123 earlier in the session, but we're climbing from those low yields. And take a look at Fed fund futures compiled by Bloomberg on the terminal. Of course, we have a bit of a lag when it comes to these traders pricing in the probability of a rate hike, but basically traders have priced out a rate hike for the end of this year.
All right, Sherry Ann, thank you. More on Fed Minutes in just a moment. And of course, you can follow the latest commentary on T-Live Go. That's T-L-I-V Go. Let's check the Bloomberg First Word News this afternoon now. Ramy Inocencio is in the newsroom with the latest.
Bonnie, thanks very much. First up, President Obama says he will slow down the withdrawal of U.S. troops from Afghanistan. Earlier today at the White House, Mr. Obama said he will keep in place 8,400 military personnel by the end of this year to help Afghan forces cope with what he calls, quote, a precarious security situation.
The decision I'm making today ensures that my successor has a solid foundation for continued progress in Afghanistan, as well as the flexibility to address the threat of terrorism as it evolves.
The president said U.S. troops will continue to focus their efforts on training Afghan forces as well as counterterrorism missions. Meantime, Hillary Clinton is on the campaign trail and ripped Donald Trump's business record in a city where he once owned casinos. She says his background in Atlantic City is a clear demonstration of what he might do to the American economy. She also took a swipe at New Jersey governor and possible Trump running mate Chris Christie, saying, quote, if your governor would start doing his job instead of following Donald Trump around holding his coat, maybe we could really get New Jersey's economy moving again, end quote. In Paris, a court has convicted 7 young men who returned from weeks among Islamic State extremists in Syria, including the brother of a suicide attacker who targeted France's capital last year. The defendants, aged 24 to 27, were sentenced to prison terms ranging from 6 to 9 years. They were convicted for their roles in recruiting French jihadis and for taking part in military training and other activities. And a Spanish court has sentenced international football star Lionel Messi to 21 months in jail for tax fraud. Messi's father received the same sentence, and the two have to pay $4 million in fines. But the Barcelona star is unlikely to miss any games. Under Spanish law, people can avoid serving time for a sentence of under 2 years if they have had no criminal record. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Ramy Inocencio. This is Bloomberg. Julie.
Thank you, Ramy. Well, still ahead on Bloomberg Markets, we will have more on the minutes from the FOMC's June meeting. And in the meantime, here's a check cross asset classes. We see the S&P 500 holding steady with a gain of 1/3 of 1%. The 10-year yield bouncing from that record low of 1.32%. It's up just a basis point right now. The dollar index little changed, and crude oil gaining almost 2%. This is Bloomberg.
Bloomberg Markets, I'm Connie Quinn.
And I'm Julie Hyman. Back to the breaking news now, the June Fed Minute. Still with us is Michael McKee in Washington, and joining us from Pasadena, California now is John Bellows. He's a portfolio manager at Western Asset Management, which oversees about $450 billion in fixed income assets. Thanks to you both, gentlemen. So, John, I wanted to start with you. We are not really seeing much difference in the markets since before the minutes. Is there anything that you saw in the Fed's commentary that would lead you to change your view of what the Fed is going to do next?
Well, of course, the minutes provide the context before the Brexit vote. So the world's changed somewhat, and that won't be reflected in the minutes. But the context before the Brexit vote, I'd highlight two things. The first is, even prior to Brexit, the FOMC participants were already highlighting the increase in uncertainty due to the slowdown in job growth. Most participants cited that as a concern. That's something to watch very carefully, and that's something that's weighing on them. The second thing that I'd mention is that some FOMC participants, so a fraction or a small number of them, were flagging downside risks to their economic outlook. Now, that's a big deal. That means that there are some people at the FOMC sitting around the table saying, you know what, it may not be appropriate to raise rates in the future. We're really going to have to be thoughtful about this and see how it goes. Again, that was all before the Brexit vote. Brexit has added to the uncertainty. They've increased the concerns. And if you take what was already a concerning situation, add Brexit, you can see why the Federal Reserve has moved to a wait-and-see posture since.
Michael, let me turn to you and ask you why there was so much confusion about the jobs report. I mean, yes, there was the strike factor, but we were able to put a certain number of jobs on that, right?
Well, it's perhaps because for so long we saw job creation basically at a standard level. I mean, for 12 months or more, we were seeing 200,000 jobs created a month. That is unusual. It's not the normal pattern in a recovery. Normally, you get a sawtooth pattern up and down, and a 38,000 jobs report wouldn't be remarkable in previous recoveries. But because it had been so strong for so long, then the question is this a natural slowdown compounded by the strike? Does it suggest that there is a greater economic slowdown underway, or is it statistical noise? And that's what they were debating in this meeting. Nobody had a really good answer, so the decision basically was, well, we don't know, so let's hold off for now, get a few more jobs reports, and see what maybe is really going on.
And John, speaking of a few more, go ahead, please.
You know, if I could, I think it's really hard to distinguish between those two things. It could just be a natural slowing after a number of months of very strong job growth, or it could be that underlying investment and demand is slowing. That's a very different and more concerning situation. So given that heightened uncertainty, given the inability to distinguish between those two things, I think the Fed's right to be cautious and to slow down.
And here's another question. Let's say that you do get, as the consensus is estimating, 180,000 jobs added in Friday's jobs report. And let's say the next jobs report following that is also positive. And let's say we get more positive economic data like today's ISM non-manufacturing report. Is that less important because the effects of a UK vote would be delayed? In other words, does that weigh on the Fed's decision-making process no matter what the U.S. data shows?
You know, I think it does, and I think it does because it's increased uncertainty, and that's going to have some negative impacts on business spending, on household spending, and that kind of backdrop of uncertainty, what we've learned since the financial crisis, can have a meaningful drag or be a meaningful headwind for economic growth. If I could, let me flag one other thing that's kind of happened post-Brexit, which is we've seen a material fall in inflation expectations. This is a big deal for the Fed. This is something we've been focused on, and as long as inflation expectations remain low, the market is telling the Fed you're not going to meet your inflation target. The Fed takes that seriously. The Fed cannot have confidence in the inflation outlook or confidence in their ability to hike rates as long as inflation outlook remains so challenged. So, you know, it'll be interesting to watch the jobs market. It'll be interesting to watch the next few months of data, but I would also watch those inflation expectations. We think that's going to be determinative for the Fed as well.
Sure. Michael McKee, let me ask you if you saw or had a chance to see much discussion of the long-term neutral rate. That was one of the other things we were looking for in these minutes.
Yeah, there's nothing in there about that. In the staff notes, they note that it may have come down a bit, but no discussion among the participants was noted in the minutes. So you're really left scratching your head as to what they think about that and whether that really affected everybody's decisions to bring down their long-term interest rates. It probably did. Most participants that we've talked to since the meeting have suggested that was the case, but nothing in the minutes about it.
So what will be the subject of discussion next time round? Is it going to be more jobs related or more Brexit related, do you think, Michael?
Can you hold that question for 8:31 on Friday morning? If we do get a strong jobs report in terms of returning to the neighborhood of 200,000 jobs, 170 to 200,000 or something like that, and then you want to look at the wages, if they continue to come in with a relative bias towards moving higher, then they may not want to raise rates at the July meeting, but they're certainly going to be talking about it in a more proactive sense, because they say, again in the minutes here, that they are data dependent and they're going to be watching the data. Still very early days on Brexit. Another reason to hold off in July. We'll have a lot more information by the time we get to mid-September about the global impact of this. So they are going to be watching the data just as everyone else is. You probably don't want to make a Fed funds futures bet right now. Instead, wait and see what happens, because that's what the minutes are telling us Fed members want to do.
Well, speaking of Fed funds futures bets, yeah, go ahead, John.
If I could just add to that, in addition to kind of their modal forecast, I think there's going to be a lot of discussion about the downside risks. You know, as I mentioned, some FOMC members are already flagging downside risks to the outlook. Brexit poses one, low inflation poses another one, and I think that's going to be an increasingly big part of that. And for a Fed that's risk management oriented, that's cautious, that does not want to do anything to disrupt the economy or markets, I think those downside risks are important to think about, and I think they're going to be spending a lot of time on those.
John, reading between the lines here, it sounds like you still would be a buyer of treasuries.
Well, so we've been overweight interest rate risk over the last month. We're overweight interest rate risk because we believe central banks are going to be accommodative, because we think inflation is going to be low, and because that's an important diversification in portfolios. That's been out of consensus and, importantly, has been a very good contributor to our performance over the last month. That said, interest rates falling to record lows, perhaps has moved a little bit too far, and so we've taken down some of that overweight. I think we'd still have a bias to have interest rate risk in portfolios, again, for the diversification benefit, if nothing else, but we have reduced just out of respect for how far yields have fallen.
All right, John, Mike, thank you so much. John Bellows of Western Asset Management and Michael McKee, thank you so much. Appreciate it.
And coming up at 3 p.m. Eastern, Bill Gross of Janus Capital joins us with his reaction to the Fed minutes, as well as his latest investment outlook.
And still ahead on Bloomberg Markets, how Kickstarter manages to keep its investors happy without going public. This is Bloomberg.
Hey. Sorry to be late. Did you hear about the NATO plane downed by Russia?
No.
The markets are a mess. Everybody's selling, or at least trying to, if their brokers are up and running.
But it's almost 8. Everything's closed.
That depends who your broker is. I can trade in Chicago, London, Hong Kong, right now. Wow. The market's already down 2%. I'm sorry, I need to do some hedging trades.
You want to trade here, right now?
Yeah, it'll just take a minute.
Wow. Who's your broker?
Bloomberg Markets, I'm Bonnie Quinn.
And I'm Julie Hyman. It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. First up, U.S. chemicals manufacturer Faro is drawing final round interest from Apollo Global, CVC Capital Partners, and Roan Capital. That's according to people with knowledge of the matter. The private equity firms are expected to hand in final offers this month. Faro makes coatings for products ranging from ceramic tiles and dinnerware to smartphones and cars.
Frankfurt is the favorite destination for banks considering a move out of London after Brexit. According to a Boston Consulting Group poll, the city in Germany beats New York and Dublin. The report says 77% of respondents expect relocations within 2 years, and London could lose maybe 80,000 jobs.
The U.S. trade deficit grew in May by the most in almost a year. American companies imported more cars, mobile phones, clothes, and industrial supplies. Meanwhile, U.S. exporters are still dealing with sluggish sales overseas. And that's your Business Flash update.
Now to technology. Kickstarter just did something that tech startups rarely, if ever, do. The company is quietly paying its investors dividends. You can read about it the latest Bloomberg Business Week. Reporter Joshua Brustein joins us now. Unusual to pay dividends, maybe, but typically investors get equity. So how is this different if it's a limited number of investors?
Yeah, the thing, usually what an investor, a venture capitalist would do is invest in a firm, and in the case that they go public or get acquired, they'll get a huge payout. And they expect to get nothing on most of their investments. Kickstarter somewhere in between. It has said it's not going to go public. It doesn't want to get acquired, and instead it started paying small dividends. And so over time, these investors may recoup their investment that way.
And it's also unusual, right, in that Kickstarter actually has profits. In other words, it's not putting necessarily the cash back to investors. It's not putting the cash back into the business. It's actually recording net income, and has been for the past few years, right?
Yeah, and those things probably aren't unrelated. Kickstarter has been turning a profit. Usually what you see with a venture-backed startup is they don't want to make a profit in the short term, because what they're hoping for is that one company that's going to be worth astronomically more, and so they want you to pour everything back in. And Kickstarter said, no, we don't want to pour everything back in. We're a sustainable business this way.
So there's a question there, right? Because is that the right thing to be doing? And do their main backers, including Union Square Ventures, back that approach? Should they not be spending every penny they have to ward off any potential competition?
Yeah, the investors that I talked to said they were perfectly comfortable with this. They also noted that this was an unusual circumstance. Union Square is the only sort of big VC firm that is backing Kickstarter. A lot of their investors are individuals who aren't necessarily looking to absolutely maximize returns. They got into it because they like the idea.
And is it hard for Kickstarter to attract talent without offering equity? In other words, if you're sort of weighing the payouts from dividends, which presumably some of the employees there are getting dividends, and getting equity in the business, how does that shake out, and how does that appeal to employees?
Yeah, I think that the idea of equity as a recruiting tool is something that a lot of tech startups are dealing with right now. It has been traditionally one of the reasons you go to work for a startup. Hopefully, they'll be the next Facebook and you'll be rich if you got in early enough. But right now, I think there's some question about whether or not those promises will pan out. And there is some interest in maybe with Kickstarter, you're going to get something.
How many investors does it have? Because at a certain point, they'll have to be disclosed, and then won't it have to go public eventually?
Yeah, they're not taking on new investors. As we've said, they're public, so they're, I mean, not public, they're profitable. So they are making, they're making money that they can invest that way. So it is a decision. Obviously, they'll have to limit the number of investors they take on.
Now, Union Square typically is out after 10 years. What's the exit strategy for Union Square here?
Yeah, I think that's a little bit unclear at this point. That's not pending right now, but they say that they will eventually have to sell, and the history of dividends will make Kickstarter more attractive to whoever comes after them.
All right, Josh Brustein, thank you so much.
Thank
really
you.
Interesting story. And Kickstarter, interesting company to be following. You can read, by the way, this story on Kickstarter in the latest edition of Bloomberg Business, where you can get more details on its operations, also its growth path, which is interesting as well.
Yeah, absolutely. Still ahead on Bloomberg Markets, we'll be taking the commodities close. And here's a look at oil. Over the past 5 days, making a bit of a comeback this afternoon. WTI crude now at 47.61, up 2.1%. That's after a couple of days of declines. Gold, of course, going in the opposite direction, up $8.50 now, 30.6720 an ounce. This is Bloomberg. Bloomberg World Headquarters in New York, this is Bloomberg Markets. I'm Vonnie Quinn.
And I'm Julie Hyman. Commodity markets are closing in New York. Let us head to the markets desk with Sherry Ann to see what is moving today.
We're seeing oil bouncing back and just climbing, and analysts telling us that this is because of some technical support as well as a slightly weaker dollar. We are seeing, first of all, let's take a look at the price of grains there, because we have corn just losing ground again, down 2.4%. We're seeing that the contract is down for a sixth day in the longest run since March. And basically what's happening with grains is that we're seeing some milder weather in the Midwest. And for example, soy prices are down today because of those better weather conditions, that improvement, as well as some profit taking by some funds. But let's take a look at the next chart and see what we come up with, because I was talking about oil. Well, we're talking about gold. Let's head to gold, because gold price is up 0.6%. We are seeing that it's again at the highest since March 2014. Not surprising, flocking to safe havens, helping push prices higher there. We also have gasoline prices today. They're rallying up 0.2%, but this is only after plunging to the lowest level since April 7th. And then we saw this surge. Of course, we have been talking not only about gasoline, but also oil prices because of that technical support, as well as some weakening of the U.S. dollar. We are seeing oil crude up 1.6% there, reversing just that sharp drop that we saw yesterday, about 5%.
Yeah, a big drop for crude oil prices yesterday. I think the biggest in about 4 months. Thank you so much, Sherry. Appreciate it. And let's stick with oil. I want to bring in Mark Schenk. He's Bloomberg's energy reporter. This afternoon, the API is going to release its inventory data for last week. Tomorrow, we'll get the Energy Department to release its numbers. It's delayed because of the holiday shortened trading week. So what's the outlook for the inventories?
Well, we're looking for them to continue falling. If they don't, that would be a huge surprise.
If they do continue falling, Mark, what's the anticipated reaction in the price? Or is the price even moving relative to inventories at this point?
You know, at this time, we've been trading on a lot of things other than the fundamentals. So what happens with the dollar, headlines about what the UK and Europe are doing, move the market a great deal. But if we get a larger than expected decline, you could see prices rebound.
Mark, I want to take a look at a chart that I have on the Bloomberg. For folks who have a Bloomberg terminal, it's G #BTV 1191. And this is looking at crude production versus inventories. Inventories is the white line. Production is the blue line. And on the right side of your screen, you see both of them are trending lower. So as Vonnie points out, in theory, the fundamentals of oil have been improving to some degree, certainly here in the United States. Where do these levels have to get before perhaps it does take precedence over the macro concerns or the speculative concerns that are out there?
Well, it can't be ignored forever. Right. And it does appear that in the second half of this year, we'll have a much more balanced market. U.S. production continued to rise. It was just, to the highest level in over 40 years. And inventories rose to the highest level since 1929 in April. So we're finally seeing a correction. Those low prices that we saw last year and early this year are finally having an impact on production.
You know, it's interesting, Mark, because you report on prices every single day and have done for a while, a long time. Yeah. We've been in a $45 to $50, $51 range yes. for a long time now. What could be the catalyst that would break us out of that range to either side?
Well, probably the fundamentals on the downside. Once we really see the overhang in U.S. supply start to dissipate, we could break down. On the other hand, and also if the fears about a European recession come true, that would also, send us lower. Of course, we can never plan on war or unrest, but, oil does come from places in the Middle East, West Africa, Venezuela, places that are very unstable.
And speaking of those places, that brings me to OPEC. We haven't been hearing much from the cartel since the last meeting, right? And the back and forth about whether there was going to be a production freeze. Is anything going on with OPEC at the moment?
It seems like they've lost relevance for the time being. The Saudis, who are the head, the most important player, definitely want to see market share return in their direction. So OPEC's kind of beside the point.
So there was a time when we were very focused on the spread between Brent and WTI, and now that spread, is very, very, very small. What are we at for WTI? We're at 47.28, Brent 48.61, so $1 and change. What is that spread signaling to us these days?
Well, right now we have an oversupplied market on both sides of the Atlantic. When you have a problem in one side, that's when you're going to have the spread widen.
Yeah, okay. So it's pretty much telling us that it's the same story on both sides of the Atlantic.
Right.
Meanwhile, gold continues to go ever higher. Mark Schenk, Bloomberg News oil reporter, much appreciated. Let's check in on the Bloomberg First Word News at this hour. Ramy Inocencio has more from our newsroom.
Bonnie, thanks very much. First up in the race to the White House, Tennessee Senator Bob Corker has taken himself out of consideration to be Donald Trump's running mate. That's according to the Washington Post, which says Corker informed Trump of the decision yesterday. The newspaper quotes Corker as saying the vice presidency is, quote, a highly political job, and that is not who I am. Meantime, House Speaker Paul Ryan wants the Director of National Intelligence to deny Hillary Clinton access to classified information during the presidential campaign. Republicans are continuing to express frustration over Clinton's use of a private email server while Secretary of State and a federal investigation that will likely not lead to criminal charges. The Department of Justice is launching a civil rights investigation into the fatal shooting of a black man by two police officers in Baton Rouge. That shooting was captured on video. Alton Sterling was outside a convenience store. Police say they went to the store because he had allegedly threatened someone with a gun. The shooting has sparked outrage and protests. The two police officers have been placed on administrative leave. And the white man accused of killing 9 black parishioners at a South Carolina church after Bible study wants the federal charges against him dismissed. Attorneys for Dylan Roof say they would drop the request if the government agrees not to pursue the death penalty. State prosecutors are also pursuing the death penalty against him. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Ramy Inocencio. This is Bloomberg. Julie.
Thank you, Ramy. Still ahead on Bloomberg Markets, Hillary Clinton stumps in Atlantic City today, taking aim at Donald Trump's business record. And at the top of the hour, an interview with Janus Capital's Bill Gross on Bloomberg Television and on Bloomberg Radio. This is Bloomberg.